Over the last week, across the market, we have seen some very mixed performances across every single industry, but our focus today is on UnitedHealth, which did suffer a 5% drop. And when we look at others in the healthcare plan industry, we can see overall they have been down, but not to the large extent that UNH has faced. And in fact, if we look at the company in a more broad terms, over the last year, they're down 25%. They've seen 1/4 of their market cap just wiped off over the 12-month period. Over the last 5 years, in fact, they're near their 5-year low. You'd only be up around 32% during this period. And for those who are longer term shareholders who have held the company for 10 years, you would be up 219%, one in which we will compare against the S&P. Also worth factoring, this is now trading at its 52-week low. This is a significant drop, nearly 50% from its 52-week highs, and we're getting a clear indication that Wall Street believe this company is a strong buy, Seeking Alpha also in agreement. Now today we're going to cover the good, the bad and the ugly from this company and understand, for one that is trading extremely low, is it worth considering adding to the portfolio? Is it high quality? Or in fact, is this a value trap, one in which will only get lower? And also worth highlighting, when we look at year-to-date performance 2025, again very mixed, not just on a industry by industry basis, but also some companies have been performing very poorly, some in fact the complete opposite, up a large double-digit, massive outperformance of the S&P. UNH in particular, as we can see, year-to-date they are down 25%, probably the only one in fact with a significant drop in the industry. We have ELV up 10%, CVS, very strong performance, up nearly 50%. That has definitely been one of the best performing stocks in the S&P so far. And we always like to start these episodes off purely looking at the valuation perspective, although remember, we're not looking at these in isolation. We will conclude towards the end when we run it through our own process. Now, in terms of a forward valuation, they're trading 14.1, not only below their 5-year rolling of 20.2, but this is the cheapest you could buy this company on a valuation perspective over the last 5 years. That is what we would say severe undervaluation signal. And on a dividend yield perspective, which tells us a company is undervalued when the yield sits above the 5-year, 1.42 rolling average, now sitting at 2.21, the highest on offer over the last 5 years. Two severe undervaluation signals for UNH. But remember, valuation is just one element of the overall process. And if we do flip to this other valuation metric, where we're looking at the 5-year average of the PE, in terms of the blue tunnel, now this gives us the expected fair price. We can see massive disparity between where the company sits and the lower end. That in itself is again another severe undervaluation, which means we're off to a good start. This could definitely be one we would say is worth considering in the portfolio up to this point so far. And if we were to look at their gradings, whilst they do get a D+, which doesn't make that much sense, we can in fact see against the sector right now the company is trading at a 16% discount, and against their own 5-year, as we've just highlighted, they're trading at a 30% discount. In fact, when you look at the vast majority of valuation metrics today, whether it's against the sector or in fact against their own 5-year, this company, UNH, is trading at a discount. And remember, what we need to understand, great, it's trading at a discount. Again, doesn't necessarily mean we should buy the company, but it does raise two questions. One, does the company in its own right deserve a discount to the sector, deserve a discount to how it's performed over the last 5 years? If we don't believe that's the case, we could be looking at one of the best opportunities in the market. And the second question is, how much is this company worth? Do we need a margin of safety? And again, we will uncover this. What also makes it a great opportunity in the market up to this point so far is that when we're looking at valuations right across the S&P, right across the different sectors, many of them are in the red. That means they are trading at some very high figures. Doesn't necessarily mean they're not a buy, but it does turn us off slightly as we want to consider high quality companies at attractive prices. And when we move on to UNH, it is firmly in the green, sitting at 12.6. Even CVS, which was up 50% so far this year, is sitting at 9.5. ELV at 10.3, and this is one way you could screen companies before deciding to look at them a bit further. And also worth noting, a lot has happened for this company, which we will uncover very shortly, and that is why we do see a lot of analysts revise their guidance. We have one that actually cut their price target to $520. As we've seen, the company has been battered very sharply, and even $520 right now would be a significant gain. We have Oppenheimer analysts cut this down to $600. Again, still a significant gain where this company's price is at the moment, which does give us one signal that this was a company before that analysts did believe was a very high quality one, and even with the cuts that we have been seeing, they still believe the upside is very strong. Again, something we will uncover. We have Jefferies with an even larger cut to $530, but look, they still believe it is a buy, and that's quite interesting because when we do look at analysts and they typically cut prices, they do either revise essentially their overall message to underperform or market form. But even with UNH, with the cuts that we're seeing, we are still noting buy signals have remained in place. And finally, we get another one which does really drill the message home. Analysts have been cutting their price targets on the company, but even with these cuts, they are still believing the company will outperform, and Bernstein in particular, $595. So let's touch upon why we have seen a very large drop. In fact, when they released their earnings on April the 17th, we actually noticed the largest drop in the company's history in over 25 years, where it was down 22%. And we can in fact notice here forecasts have been cut as medical care costs have in fact increased. So we can take a look at a little bit more detail and understand whether this is something perhaps can be longer lasting. But one of the reasons why we did get a very large drop in the share price is ultimately because investors did not see this coming, and that is what we will see in the market. Perhaps some things are baked in already. Analysts know that guidance will be lowered based on how the wider economic climate is, but with this company they weren't anticipating this, and that is why we got that incredible large drop. And we can see they've lowered their adjusted profit per share 26 to 26.50, which is quite a significant drop in the grand scheme of things when you look at what they were expecting on the previous guidance, 29.50 to 30, and analysts were anticipating for the full year at 29.73. So again, this isn't something, as we can in fact see here, that anyone was expecting, either a miss to in fact their overall performance in the latest quarter and a cut to their overall guidance. And unfortunately, given the fact that they did talk about a surge in medical care usage, particularly among the Medicare Advantage enrollees, with care utilization increasing at twice the anticipated rate, this is something that may perhaps also continue in the next few quarters. But we also want to highlight their performance purely from a numerical perspective, because we always need to take a step back. Yes, we understand the external noise as well as factors that are having a play on the business. We can in fact see their revenue was just under 110 billion. That is pretty much a double-digit 10% growth from the same quarter last year. That is still looking very strong for a company that has dropped 22% just upon the release of their earnings. That is what we would say at the moment with the data available does look like a large overreaction by the market. And they also continue to serve more and more customers, up 780,000 year to date. And one thing that we do like about management and what they have discussed in the overall report is that over the longer term, they want to return to their earnings growth rate target of 13 to 16%. That is very strong when you think of a company that is trading now at this low level. If they do manage to go back to the 13 to 16%, this could be one of the best turnaround plays. But again, you do need to have conviction in the longer term that the issues we are seeing right now is more of a shorter term impact than over a large period of time. And just to reflect on the numbers, 110 billion reported this quarter, the same quarter in 2024, 99.8 billion, and if we go in fact just to the previous quarter, 100.8. So lots of growth, looking very good, as well as the earnings from their operations, 9.1 billion, 7.9 from the same quarter last year, the previous quarter at 7.8, and their bottom line net margin, something that we will also compare not to their own historical performance, but also in fact to the sector, 5.7% up from the previous quarter at 5.5. So purely from the numbers that they reported, there are no issues that we can see other than the fact that they did cut their guidance, and that is something we will in fact note in the shorter term. And some other non-financial information that we need to consider is that they are being sued or trying to be sued by shareholders over the reaction to the backlash from the executives killing. Now again, we can take a look at a bit more meat behind the information to understand the overall impact, but essentially a shareholder lawsuit has now been filed that alleges that UNH failed to disclose the business's impact of the public backlash after the 2024 shooting. Now, the suit does complain that the company in fact concealed how it shifted away from strategies that resulted in higher than average claim denials affecting profitability, and the lack of transparency allegedly misled investors, contributing to the steep stock decline. So again, it isn't just the numbers that we are seeing affect the company's stock price, but also we are getting this lawsuit now, and it is something that's a little bit more difficult to factor in, but that is why ultimately we always like to use a margin of safety when we get to our overall figures. Worth also highlighting, in February, again, 2025 just hasn't been a good year for the company, noted in the very large drop we have seen year to date, but they also suffered a significant cyber attack in February 2024, disrupting their electronic payments and medical claim processing, and it ultimately led to widespread operational challenges, financial strain on the company, as well as paying out, as we can note here, more than $3 billion, although we do believe the number has now risen to around $6 billion. And I'm sure for those that do follow the company, you will remember February we had the US Department of Justice launch an investigation into their billing practices, focusing on allegations that the company documented diagnoses leading to larger payments from their medical advantage plans, and this also caused the company's stock price to drop nearly 9% at the release of this information. So there is a lot to consider. It isn't just purely valuation, where we would say the company is looking like a great opportunity, but there are some other things that you need to bake in when you are looking at this company in your own investment thesis. Hopefully we will add a margin of safety when we come to our own price that we do believe is a great addition. And worth noting, over the next 4 quarters, they do anticipate only one of them to be growth, with a 75% track record, 3 out of 4 beats against analyst targets. Most recent quarter, as noted, they missed earnings per share by 9 cents, as well as in fact cutting their guidance. For those that want to see December 2026, $30.54 EPS target, lowering the forward P even more to $12.46. Again, we have no issues on a purely valuation perspective. The company does look severely undervalued. Now, what are the institutions doing? They hold 88% ownership. They in fact sold $41 billion worth of shares over the last year, whilst buying a bit more at $50 billion. So you could say a little bit more bullish than bearish, but in the most recent quarter, by the end of March 2025, they bought a significant amount more than 3 times, $11 billion versus $3.64 billion worth sold. So clear to see in 2025, at least up to this point, institutions still very, very bullish. And if we wanted to see the opposite of that trend, where we note more selling than buying, you'd have to go to Q1 of 2024, where we get in fact more than double the sales. At the moment though, the signals do point to institutions being a lot more bullish. And if we go to what insiders themselves are doing with 0.33% ownership, we get $500,000 worth of buying over the last year, but we get more selling at 2.49 million. Now, no movement in Q2, in Q1, so the most recent period of movement is in fact buying at $500,000. Q4 nothing. The selling, we would have to say, is outdated. However, you could argue Q1 buying is in fact very positive, as insiders typically buy because they believe the share price will go up. Now, it was a direct in fact on the 17th of January. Again, up to you whether you believe that is outdated. 1,000 shares costing them $500,000. Information is here again if you do want to use any of this as part of your overall thesis, and keeping it consistent as we like to do on the channel, looking at super investors. Now, we have 17 that actually hold this within their own portfolio, and at the moment we don't have the likes of Bill Ackman, Warren Buffett, Bill Gates and their movements. However, we are expecting this over the next few days and weeks. Make sure you are subscribed, notification bell is on, so we will report when the information is there. In terms of UNH, now we have seen in this most recent quarter a few buying as well as a few trimming, and the same to be said in the previous quarter. Now, given the fact that this doesn't make up a very large percentage of their portfolio in Q1, nothing really to say. but will be interesting as we will identify over the next few weeks if we see any large percentage change. Now let's get to the quality of the company. As we've spoken a lot about the valuation, it does look good, but is the quality high? Something we want to note. Now first things first, dividend safety 90, very safe, great to see. We've covered these two severe undervaluation signals, and in terms of dividend growth, 12% was the most recent in June 2024. We'd love to see that. In terms of dividend safety, now we have to point out just a few weeks ago it was downgraded. It was 99. Now in fact it sits at 90. Still very safe, and the message is still the same. A dividend cut for the company is highly unlikely. Now for those that believe a recession may be inbound, key metrics from the 07-09 crash: maintain the dividend, didn't increase, didn't in fact cut it, plus 5% recession sales, well above the average of the S&P, negative 12, but they did unfortunately trail the S&P, negative 63%, S&P itself, negative 55. Dividend growth, we love this, double digit, very consistent year on year. In fact, over the last 10 years, they've been increasing it above 19%, something we always want to see from companies we're invested in, whilst they've also been increasing those dividends for the last 15 years, whilst paying a dividend for the last 32 without a reduction. As always on the channel, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want for this metric, gives us faith they can continue with the double-digit increases, very consistently below the 30%, although on a trailing 12-month, 31%, expected to be lower over the next year. So we do anticipate this June, hopefully in fact next month, another nice double-digit increase, something we would be surprised to see if we don't receive that. In terms of free cash flow, consistent growth over the longer term. Again, we get that for the large part, a drop in the most recent year, expected to climb up in a very sharp fashion to $31.30, so that is a very good sign. And then we get to the sales growth, where again, very impressive, minimum 3 to 7%, 3 to 4 in fact, just to keep up in line with inflation, looking very good, whilst inconsistent, no complaints whatsoever, 8% increase in 2024. Total sales, again, very strong, more than 2 times increase over the last 10 years, although we will look at this in a little bit more detail shortly. And what they've also done is return some excess cash to investor pockets through those share buybacks. As we can see, it has reduced over the last 10 years. Not that much though, so it does signal to us in fact that management don't prioritize this in terms of capital allocation, but who knows, given the share price has plummeted significantly over the last few months, they will consider in fact implementing a large share buyback program. ROIC 10% or more, give us faith, management are able to effectively allocate their capital, looking very strong, very consistent. That is always a great sign. Consistency and very good numbers, that is something we love and something we do in fact know. In terms of margins, above 12% is what we want to see for the majority of companies. Not what we get here. One thing we would say though is when we compare it against the sector, it is still very strong. This is something that is typical in the industry, so no worries, no red flags here. And free cash flow margin, no complaints, straddling around the minimum 5% that we do in fact want to know. Then we get to the net debt to EBITDA. Now this, as always, correlates to dividend safety, balance sheet strength. Numbers you see below, number of years it would take them to pay off all of their debt net of cash on hand. 1.39 2024, looking good. Trailing 12 month 1.2, expected to go lower. These are all strong signs of a very good company, and again we'll highlight the balance sheet, but based on this analysis alone, it does look like it is very strong, and there are again no red flags to raise. In terms of the growth, now they do get an F, but year-on-year revenue and forward-looking, sitting in the 8 to 9% region, is slightly above the sector in the mid to high single digit, and we also notice they're only trailing their 5-year average very minimally at 10 to 9%. And if we do look at the EPS, one that perhaps lets this company down in their rating overall, they're anticipating growth over the next 3 to 5 years, 7.7%, below sector at 10, below their own 5-year at 13.4. Profitability though does look strong at an A+, gross margin 22%, a lot lower than the sector actually at 60, but when we look at their 5-year average, again a little bit lower as that sits at 24.5. In terms of bottom line, that is pretty much where the company shines. 5.4%, sector in essence is burning through cash, negative 3%, and their own 5-year sits only trivially higher at 5.6%. Cash from operations is also very significant at 29 billion, given their 5-year average sits lower at 24, and we can also highlight here the sector just is burning through cash, negative 12 million. Now, quick recap for this part of the analysis: a strong buy from Wall Street, a buy from Seeking Alpha with a hold from Quant, D+ on valuation, F on growth with an A+ on profitability. Now, the other thing that we do want to reflect that in this industry as a whole, there are some great opportunities. One, in fact, ELV that has a lower forward P than what we saw from UNH is also a great one to consider, which is also trading near the 52-week low. A double buy from Seeking Alpha and Wall Street 4.4, not far off the 4.5 to flip this into the strong buy rating. And over the last year, pretty much following in UNH footsteps, down 25%. Over the last 10 years, though, it is up 151%, marginally outperforming the S&P. And like UNH, we do get that double severe undervaluation signal, 11.5, well below the 5-year rolling at 14, and the yield on offer at 1.7 does sit above the 5-year at 1.23, whilst also getting that confirmation when we do take a look at this model, disparity between the 2 points. So another company we just wanted to point out in the industry that does look undervalued, at least from a valuation perspective. If you want an in-depth dive of this company, do let us know, but always good to look at other companies in the industry even at a very high level. And if we circle back to UNH, we can see how they formed against others in the sector, including ELV, others like CNC, Humana as well, many popular names that also have been hit very hard. In fact, over the last year, including reinvesting those dividends, every single company, in fact, bar HQY, is up, telling us that the industry has been hit very hard. And whilst it may not be an isolating point that UNH is down, we can see the sector, in fact, is contributing to the overall performance, at least for UNH in the time being. And if we expand to over the last 5 years, we do get a bit of a mixed performance from the industry, although UNH is still up 42%, ELV a little bit better at 58%. And if we zoom out to the last 10 years, UNH up 272%, one of the best performers. In fact, we do get MOH actually the best performer, up 366%. So this does tell us for longer term investors, you would be fairly happy, but as always, past performance is not an indicator of the future. And if we were to reflect on the same analysis but against the S&P, UNH is down considerably, negative 24, the S&P itself up 9%. If we do the exact same over the last 5 years, UNH up 42, S&P again outperforming up 93, but where things do change, in fact, is over the last 10 years, UNH up 272, S&P up 167. And remember, if you don't have conviction that it can outperform, at least for your time horizon when you are investing, you can always consider a low-cost ETF that tracks the S&P like VO. Now, we also want to highlight the company's income statement very briefly. We've already talked about their top-line revenue growth, very consistent. We love the growth, going from 157 billion to now sitting at 401 billion in 2024. But we want to understand, what does the bottom line net income tell us? Does it follow a very similar pattern? And we can see for the large part, the answer is yes. We do get a drop off, in fact, into 2024, going from 5.8 billion, now sitting at 14, although on a trailing 12-month basis, 22.1 billion does give us an indication that things will pick up into 2025. And then a fairly similar analysis, but we're looking at the balance sheet where we're doing a quick health check, total cash versus total debt. Cash has increased over the last 10 years, going from around 11 billion in 2015, pretty much tripling to the latest quarter, sitting at 31 billion. But as always, one number here, pure isolation, will give nothing away. So we compare it to their total debt numerically and directionally, which has actually been increasing over the period. 32 billion, now sitting more than double at 81 in the latest quarter. Now, we did see net debt to EBITDA does look good around the 1 mark and is decreasing. So for now, things do look okay. But as always, quarter by quarter basis, we should keep our eye on certain metrics. This is definitely one of them. Now, we also want to let you know before we jump into our valuation that we have released our latest free weekly article. We drop one every single Monday morning, so a fresh copy coming tomorrow for completely free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. so click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of May, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. Now jumping to our intrinsic value in the episode, we get to $506 based on the latest earnings, and it is purely the average of the 4 models that you see on screen. Now we're going to run through each model discussing the inputs and the outputs. First one, we have Graham's valuation, where they in fact lowered their earnings per share. We have the growth rate, the AAA corporate bond yield, to give us our intrinsic value of $360. That does give us our first overvaluation signal, but bear in mind we're not looking at any one of these models in pure isolation. Then we have the multiples, companies in a similar sector and size that we just took a look at, their average P multiplied by the EPS of UNH to give us our second intrinsic value and in fact our second overvaluation signal. We then move on to the dividend discount model, where we have the yearly dividends year on year, average growth very strong, as in fact we noted 14%. Moving forwards, we want to be a lot more conservative given some of the issues may become longer term, although that doesn't seem to be the case from the information today. In terms of the growth rate then, 6.75%, intrinsically massive undervaluation signal. And then we end on the DCF model, free cash flow year on year, average growth 14%. Again, we have been conservative at the 6% point. And then we get the discount rate, where we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us $593, which in turn is an undervaluation signal. So we get 2 undervaluation signals, 2 overvaluation signals, giving us an average of $506 in the episode today. And don't forget, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for UNH or any others. But based on the current price at $380, and we're not just on there, we do always like to add a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $456, then we keep going till it's near the current trading price. In essence, what we're saying, you're not getting a 30% MOS just yet. That would be a buy at $355. At 25%, pretty much bang on where we see this company today. Now, there are a lot of issues with the company that we have touched upon. In fact, when we just consider them, they had the earnings miss, they lowered their 2025 forecast, they've got a shareholder lawsuit following the CEO's death, we have the probe from the Department of Justice, as well as the healthcare cyber attack and some other market volatility and sector-wide pressures. But is 25% MOS sufficient for you today? Something to consider. Wall Street themselves see this at $560 over the next year, upside of 47%. They have this as a strong buy rating. Give us your thoughts. 25% MOS, 47% upside. For those that do want to see at 30%, a buy at 355, at 35, 329, and at 40, 304. And don't forget to sign up to the free weekly newsletter. New one coming to the inbox tomorrow morning. Grab those spreadsheets. Come and join us in the Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.